Hey everyone, welcome back to the channel, where it's the best place to learn about Canadian finance. Now for this week, I want to talk about insurances. Now I want to talk about this topic because going forward, we're for sure going to go through a very low interest period of time, and there are even articles talking about a possible scenario of a negative interest rate. Now, since all long-term investment companies like insurance companies or your pension plan, they all rely on long-term bonds, having a low or even negative interest rate is really gonna greatly affect their performance. And what that means is in order to keep up with the insurance in the future, we're likely gonna see multiple increases in price for the newcomers in the future. And also, from meeting with a lot of new clients recently, I realized that their existing insurance setup a lot of times is not suitable for what they want in the future. So I want to make this video to make sure everybody will understand the basics of insurance and make a better decision for themselves. So without further ado, let's jump into it. Alright, so before we start, a couple of things to go over. Number one, make sure you like this video so it spread to more Canadians to help them out. And number two, we have a private group on Facebook. Make sure you click the link below to join us so you can ask questions and get more content in the future. And number three, I've had a lot of comments and questions asking things like, what kind of camera do you use? What kind of mic do you use? What kind of books do you read? What kind of course do you take? So what I've done is curated a list of tools and books that I've gone through myself and I found extremely helpful. So if you're curious, click the link in the description below. It's going to take you to my website to give you that list. Now, just to be extremely transparent, all the links I've listed onto the Amazon, it's an affiliate program. So if you use any of those links to get anything, it does directly support this channel because we get a small portion. And hopefully in the future, when this channel is profitable enough, I'll be able to hire more people to help me do research so we can provide even better content for you. Alright, so first let's talk about some common misconceptions or questions I hear all the time when I meet with a new client. So the first one I always hear is insurance companies are shady. And a lot of people that are saying this, usually they have previous bad experience, and most of them have these kind of bad experience in other countries. Now, I'm not sure how insurance industry work in other countries, but in Canada, insurance is actually one of the oldest and most heavily regulated industry in Canada. And that's because of this guy. Now, his name is John A. Macdonald. Not only is he the first Prime Minister of Canada, he's also the first president of an insurance company called Manulife, which I'm sure you all have heard of this name before. So as you can see, it has an extremely long history of being around. So this country is actually very mature and knowledgeable in dealing with this industry. They have an extremely rigorous set of rules and different bodies of legislation to govern the whole insurance industry as a whole. Now, the second thing I always hear about is insurance companies going to find ways not to pay you. Now, to handle this issue, there's something called 2 years of limited contestability period from the time you start buying the insurance. Meaning that if something happens to you within 2 years of you buying the insurance company have the right to suspect something fishy might be going on, and you may have pre-planned this or you may lied on your application, and they can challenge you for that. Now, after the 2-year period is over, there's no way insurance company can contest you, and as long as it's not a fraud, you did not lie on the time of application. For example, you have cancer, but you said you're healthy. As long as you didn't do something like this, they will have to pay you. So this is why I advise my client all the time that you need to be extremely honest in your application. Don't try to hide anything. As long as you're very honest on the time of application, after 2 years of contestability period, they cannot challenge you and they will have to pay out. Alright, so the next thing people ask a lot about is, what if insurance companies go bankrupt? Will it happen? And if it happens, what will happen to my insurance? Now, while it is true that all companies have the possibility to go bankrupt no matter what they are and how big they are, it's going to be very unlikely for an insurance company in Canada to go bankrupt. And that's because of something called life insurance adequacy test ratio. Long story short, this is a formula that the government came up with every year to test all insurance companies in Canada. It basically wants to test, compared to all the claims you have sold to consumers, how liquid is your company. Now, the government requires all insurance companies to maintain at least a 90% of total ratio every year if they want to stay in business and keep selling insurance. But as you can see on the screen, all major insurance companies have well over 100% on their ratio. So what that means is they definitely have enough asset to stay solvent even if they have to pay a massive amount of claims. In addition, there's also a backup called Assurance. Assurance is a non-profit organization that will step in and act as a backup should something happen to an insurance company. So as you can see, that's what I mean by in Canada, there's a lot of regulations and mechanisms in place to make sure insurance is going to pay out and protect you as intended. Now, the last thing I hear a lot all the time is people are saying insurance is not worth it. Actually, depending on what you want, insurance could be an extremely cost-effective way of achieving some of your goals. Imagine if you're someone that's going to retire and you want to leave $1 million for your grandchildren. You basically have two choices. One, you can leave actually $1 million of cash in an account, stay invested, and hopefully it doesn't lose money, and when you pass away, you can give them this money. Or number two, you can actually buy a $1 million coverage insurance, paying usually anywhere from 1/5 to 1/4 of the cost as premium. Now with that in place, you can actually spend the rest of it on yourself, knowing your grandkids are going to be covered for that 1 million. In addition, insurance is not just about protecting and paying out money if you get sick or you die or get disabled. It also could be a great investment tool because due to a stable long-term return and also some mechanism inside to make it tax shelter, which I'll go into later. So it can definitely extend into an investment tool as well. Now with that being said, it's definitely not a perfect tool that's always suitable for every single person. However, there's definitely a place for insurance, and that's something that you should consider in your own financial planning as well. Now with that out of the way, let's move on to the next section and look at the different types of insurance and the different ways of getting it. Now, no matter which kind of insurance you're looking at, there are really 3 ways of getting it. And the best way to think about this is to think about it as if you're getting a car. So the first way is what I call renting. So as you can see on the graph, for the price wise, it's going to stay the same for a limited amount of time, usually anywhere from 10 years to 20 years. Once you hit the limit, if you want to keep this insurance coverage, it's going to automatically renew at a higher price. Usually this higher price is going to be 3 to 10 times as expensive as you are paying now, depending on your age at that time. Also for renting insurance, usually when you hit 75, even if you're willing to pay the extremely high premium, it's going to auto cancel for you. So the pros of renting is out of all 3 ways of getting it, renting is the cheapest one. Now for the cons, there are several. One is the huge price jump every time it renews. Number 2, it also doesn't cover you for life. It's going to self-cancel at 75. And number 3, there are no cash value inside. There's no growth inside. It's a pure insurance that's going to give you protection. So this kind of insurance is very suitable if someone is very young, they just started a family, they need the coverage, but they have limited budget, or someone is older already, they want to have some temporary coverage while keeping the budget under control. Now, the second way of getting insurance is what I call leasing, which is also known as pay-as-you-go. So as the name suggested, you'll be paying one fixed price and it's gonna last until you cancel the insurance or you make claims to it. Now with this type of insurance, there could be some cash value depending on the company you're working with, but generally the cash value is extremely low. The pros of these is out of all 3 ways, is still the cheaper way of doing things. Not as cheap as the renting one, but also not expensive as the third way of getting it. Also, it has one level price that there's no price jump and no surprise in the future. Now, the downside of leasing insurance is number 1, you potentially have to pay for a very long time if you live a very long life and you want to keep this coverage. And number 2, like I said, the cash value is little to none, so there again is basically no growth inside this insurance. So this is very suitable for people that want a permanent coverage, unlike the renting one that will self-cancel at 75. But they want to keep the budget under control, and also they don't care much about growing the money inside their policy. Now the last way of getting insurance is what I call buying the insurance. So with this insurance, usually you're guaranteed a fixed amount of time you're paying into it, usually anywhere from 10 years to 20 years. Once you're done paying into it, you own it for the rest of your life. In addition, usually there is cash value that will be growing inside the policy, so it's kind of like an insurance investment hybrid. Now the pros of this is that number 1, you are paying a limited amount of time. right? So you don't have to pay forever. Number two, you get to keep it as a permanent insurance. And number three, there's cash value that will be growing inside. And usually when the cash value grows, your death benefit will grow along as well. So in the future, your coverage might get bigger and bigger that can keep up with inflation and also grow to a bigger amount. But the downside of buying insurance is this is the most expensive way of doing things compared to the other two. So this is suitable for someone who is seeking to take advantage of the tax shelter growth that can happen inside the insurance, so they're treating it like a long-term investment tool. Or someone that has a corporation and they want to use insurance as an investment tool and also corporate tax planning tool and get those corporate money out in the future. Now, in addition, as you're building up cash as the policy is growing in cash value, it's also going to become part of your asset. And because it's an asset, you can also take the insurance policy to go into a bank and lend against its own cash value. Now, this is more complicated, so I'm not going to dive into it today. But essentially, this could be a very good place for you to tap into for future investment, corporate planning, or creating a tax-free retirement income stream. Alright, so a lot of people will now say, well, what is the best kind for me? The answer is there's no such thing. Every type of insurance have its own needs and uses, and it really depends on your own situation. You can also mix different types of insurance together to create a unique solution for yourself that fits your goals. Now, in addition to the renting, leasing, buying that I just explained, there are also a lot of small configuration as you see on the screen that could make a huge difference when you set up your insurance. So if you're getting insurance for yourself, as a tip, definitely find a trustworthy advisor, someone who's not just trying to sell you a product, but willing to listen to you, work with you, understand your current situation and your future goals and needs, and really come up with a solution together that makes sense for you, coverage-wise and also price-wise. Now, even though I told you that all insurance have its own place and its unique use, and there's really no good or bad insurance, there is one type of insurance I want everyone to be very careful about. Because I've seen too many times people have got them in the past, they have no idea they got this type of insurance, and they could be in for a very bad surprise in the near future. So if you watch my last part, you might say, hey, I want something like a buying insurance. I like that. I want to grow my money. But the cost is too expensive. I want to keep the budget under control. And someone may come along and tell you that, hey, I can offer you the exact same thing, but at half the cost. Now, is that really the case? So before I dive into it, I want to make this extremely clear. The insurance company is extremely mature, like I said before, and with this much money in the market, they have a lot of very, very smart math geniuses working for them that are working the numbers every day to make sure it makes sense for them and the consumers. So if there is really a way to do the same thing at half the cost and can make it work for both parties, people would have figured it out already and everyone would be doing it. And you would not see the more expensive type of insurance even being offered anymore. So then what is it? How come some people can make such claim? Now, this specific type of insurance is something called a yearly renewal term, YRT, or annual renewable term, ART. They have different names, but they basically mean the same thing. And you can usually find this setup inside something called universal life, which is usually a hybrid between leasing or buying, and it's extremely flexible and you have a lot of choice inside. Now, I want to preface to say that I don't mean this kind of insurance is bad and is not suitable for every single person. It does have its place and its unique use. It's just the way it's presented to a lot of clients, from what I see, have issues and it's misleading them to believe it's something that it is not. So usually when you sit down and look at this kind of insurance, on paper, it's going to look very nice and it does look like you were able to finish paying in 20 years and keep it for life, and it will also grow in value and death benefit. However, in reality, this kind of insurance is actually set up something like this. Even though you're paying a fixed amount every month, your actual cost of insurance is actually different every year. It's going to start off at a much lower amount than what you're paying, but it will gradually increase as you get older. And eventually over time, the cost of insurance per year can get extremely outrageous. So the idea is this: in the early years, you're paying an amount that's above the actual cost of insurance, and this extra payment is going to be taken to keep investing on the side in hopes of growing it. there will come a point where the actual cost of insurance have increased to more than what you're paying into the insurance. So the idea is hopefully when we get there, all our extra payments before would have grown into a nice amount that can continue to pay for future increasing premium. Now on paper, this concept makes perfect sense. The early investment that we've been doing, the extra premiums, would be able to grow in the sizable part given a long period of time, and it should be able to cover the rest of our payment in the future. However, you need to be careful when someone's presenting this idea to you, what kind of assumption they're using to make this number work. Some people will be using an assumption of 8% to 12% per year of return in order to make this attractive and make it work. But we all know two things. Number one, 8 to 12% a year is extremely difficult to keep consistent, especially given what we're going through in the market right now. And number two, the market doesn't actually work in a straight line. 8% per year in a straight line return is going to look completely different than an 8% average in an up and down market, which is more realistic to an actual market today. So that's what I mean by being careful of how it's presented to you, because this might all look very nice and dandy on paper, but what happens when the actual return isn't performing as well as the assumption? Well, that's when you hear horror story from people buying insurance 15, 20, 25 years ago. They thought they're done paying, and suddenly they get a letter in their mail telling them that their insurance no longer have enough cash value growing to sustain their future premium payments. And if they want to keep this insurance, they would have to restart their payment. And now the payment, because of increasing costs, have become very expensive already. So this type of insurance have its pros and definitely its cons. The important thing is be very aware how it's presented to you and make sure the assumption is not overly optimistic. So again, this is why I reinforce, you really need to find a trustworthy advisor, someone who's willing to sit down with you, understanding your needs, understanding your goals, willing to work with you, and come up with a good solution together. So I hope this video will give you a much better idea of how insurance works and what kind of options are there for you to start your own conversation. Now, if you like these kind of video, I do upload them 8:30 EST every Tuesday. So make sure you comment, like, and subscribe to my channel and click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next Tuesday. Bye!